As we move into 2014, it's a good time to pause and reflect to see where we've come from. As the philosopher Santayana said, if you don't know where you're coming from, it's hard to gauge where you're going. So where have we come from? Basically what's happened over the past few years is reserve banks throughout the world, led by the Fed in the US, have practiced what's called financial repression. Effectively, what they've done is manipulated interest rates to very, very low levels, effectively zero, to make the cost of debt very cheap. So what they're doing is are asking savers to subsidize those who are in debt. And that makes it tough for savers because savers are finding it hard to generate an income on money they might have on deposit in the bank as they did in the past. So they're sitting there, investors sitting there thinking, what can I do with my money to generate a decent income because the bank, due to financial repression, is not paying me enough interest income. So the obvious answer is, and the financial product promoters have come up with a great answer, the obvious answer is buy the equity of good quality companies that pay growing dividends. Now that makes a lot of sense, and it's a very comforting type of asset to buy because you're buying good businesses and they pay dividends that grow over time. What could be better? The problem is the returns on your investments are not determined primarily by the type of asset you buy, but by the price you pay for that asset. And because of this quest for income forced upon savers by financial repression, investors or savers are paying too high a price for these good quality businesses that pay growing dividends. So financial repression is working. It's forcing savers and investors into more risky assets. However, we feel that the price being paid for those assets is far too high, and that is why we're avoiding them. We think there's far too much risk in those type of investments. Where we are finding good value is in the equity of businesses that are cyclical, that are income constrained at the moment because of a poor economic environment, and that can't pay dividends as a result of that poor economic environment and weak business conditions. The equity of these businesses are priced at generational discounts. They are very cheap because nobody wants them. Everybody wants the good quality business that pays growing dividends. And there's a bifurcation in the market as a result of that. As value investors, we are gravitating towards the cheap assets because that's where long-term the rational investor finds safety. So in the midst of turmoil in financial markets, uncertainty about economic growth outlook, interest rates rising, all this uncertainty, safety is found in cheap assets, as it always has been in the past and as it always will be in the future. And our funds hold a lot of those cheap assets. Now, up to about 6 months ago, the returns in the short term from those assets were quite poor because as economic prospects darkened and investors gravitated towards the dividend paying companies, the equity of these cyclical assets was sold down and continue to be sold down. So every time we bought more Impala or more Amplats, the share price continued to decline until about 6 months ago. A sea change started happening and we've picked that up. So despite the recent turmoil and interest rate hikes and stock market sell-offs, the equity of these companies, the price of that equity has actually started picking up quite nicely. And again, we're starting to find safety in cheap assets. And at the end of the day, the winner in investing is not the one who makes the most when asset markets goes up. It's the one who loses the least when times are tough. And right now, that is how our funds are positioned, and we're very comfortable with that fact.